And in a service business, that's usually the largest expense. In a merchandising business, it would be the cost of our inventory that we've sold. In a service business, wages expense. $1,185,300. Okay, looking at the rest of our expenses, which one would come, that we labeled expense, which would come next in order of amount? I think it would be rent expense. So write in rent expense. And that's $340,200. Going down the page, the next one I see is utilities expense. I think that's the next largest. And utilities expense, $202,500. Again, I'm just copying it from the page. Going on down the page, it looks like supplies expense is the next one in order of size. And supplies expense is $63,900. As you're listing these, if you'll cross out what you've already done, that helps you to see what you have left. All that I see I have left are 2 expense accounts. And it looks like of those 2, tax expense is the largest, so I'm going to list taxes expense next. For $50,400. And the last one I haven't crossed out is miscellaneous expense. Miscellaneous expense should be your smallest category because a company really shouldn't be putting a lot in miscellaneous. It always seems to send up red flags because nobody really knows what that is. And the IRS may question it as well. So miscellaneous expense is generally always last and should be the smallest. I try to stay away from using that category unless I really have to. So I don't want to have to explain what's in there. In this business it was $24,000. And we're going to add our operating expenses down to get $1,866,000. That's all we're doing there for total expenses. We're just adding all those together. Now the last line here on the income statement is our net income. What you don't want to forget is that you're going to be subtracting expenses from revenues, not adding. Wish we could add. But we've got to subtract to get net income. Anytime you see the word net, that means something's taken out. So subtracting coming down to net income, $502,500. Is what we should have left. Right. The next statement is the retained earnings statement. The part that should be true to form here is the name of the company is going to go at the top. The statement comes next, and if you were using the blank forms I have, you'll just go ahead. It's already filled in for you. You're going to put the period of time. The period of time should match what you have on the income statement because these are going together. So this is going to be for the year ended. June 30, 2011. I'm going to start this first line. Notice how it has a blank there? All the statement of retained earnings does is it shows you what you started with in retained earnings at the beginning of the period. You have to add in your net income. Again, it's coming from here. Take out any dividends you might have. And you're looking at the increase or decrease in retained earnings, adding it to the beginning balance of retained earnings, come down to the ending balance. So on this first line, you can see where I have a space there and it's underlined. You need to put whatever date it was at the beginning of the year. So if our year ended as June 30, 2011, what would the first day of the year have been? Again, this is a fiscal year, not a calendar year. A fiscal year for a business can be any 12-month period they choose. So this would be July the 1st. of 2010. Okay, the balance was, where are we going to get that balance from? Remember when I told you that you needed to go back and make sure you read all the information in the paragraph before? It tells us in this paragraph the retained earnings was $315,000 at the beginning of the year. So I'm going to put $315,000 over here in this column. All right, the next line says net income. Where do we get the net income from? Haven't we already calculated that up here? Okay. Remember, financial statements are prepared in a certain order, so you're going to be adding the net income right here. So just bring it down, $502,500. Okay, the next line says less dividends. Dividends is how we pay our owners in a corporation. And it tells us that, if you go back and read the narrative, dividends of $270,000 were paid for the year. So we're going to put that $270,000 there. And now if you're ready to subtract that, net income is positive. Dividends, it very specifically says less. So that's a hint, you should be subtracting it out. Now if for some reason on our income statement, let's go back and review that for a minute, if the expenses were more than the revenues, we'd have a net loss. And I've always noticed that in textbooks, they don't show those net losses very often. In beginning textbooks, they just assume all business, make this assumption all businesses are profitable. But that's not always the case. So if you had a negative number here, this would actually be negative as well. But it's not. We had a positive net income, and then we subtract out the dividends that were paid to the owners, the way the owners get paid, and we should have $232,500. We're going to add that to retained earnings for the beginning, that we had at the beginning of the period, to give us ending retained earnings, which should be $547,500. And the date we're going to put in here is the date of the statement, which is June 30, 2011. If we turn the page, you'll find on your next page another statement. This number here we're going to have to use on the next statement, which is our balance sheet. So we don't want to forget about that $547,500. We're going to start out on our balance sheet. I've already got it filled in for you that the balance sheet is going to have assets, liabilities, and stockholders' equity. There were 4 handouts with this particular unit. All right, we're going to start at the top with the name of the company, which is the same as it was on the last page, ABC Travel Service. So I hope if you can't remember anything else, very important you label what company you're doing this for. Also, the date. The date for the balance sheet is not a period of time. It's as of a specific date. All right, I'm going to be, first it's giving me a big hint here. I'm going to be listing my assets on the balance sheet. So, when we're listing our assets, I will tell you that cash always comes first. So let's list our cash. I see that on our sheet. Cash, a resource owned by the business, very important asset. $477,450. All right, what other assets do we have? I see a couple other things that we've labeled as assets earlier. We have accounts receivable. Of $282,150. And we also have supplies. Again, another asset owned by the business. Resource owned by the business. $30,150. Okay, adding those down. Once we've listed all of our assets, we add them down. I don't see any others. We should have $789,750. section of our balance sheet shows our liabilities, what we owe. And the only liability I think I see here that we put a big L beside is accounts payable. So I'm going to go ahead and list accounts payable. And the amount is $107,250. All right, in our stockholders' equity section, if we only have one liability, that's great. A business doesn't have to have any liabilities. They really do need to have assets and equity. If they don't have liabilities, just left out of the picture. This business only has one, so that's good. On the stockholders' equity section, we're going to have two accounts for right now. Later we'll learn about some more detail that we could add to this, but for right now we're going to have capital stock. That's the stock that's been purchased by our stockholders, that we've issued to stockholders, of $135,000. And retained earnings. It's all the earnings that have, net income that's been retained in the business since it started, minus any dividends paid. Where are we going to get that number for retained earnings from? We have to go back and get that from our statement of retained earnings, which is $547,500. Okay, if we add these two together now, we'll get our total stockholders' equity, which should be $682,500. Okay, going on down the page, the last thing here on the balance sheet says total liabilities and stockholders' equity. So we're going to add our liabilities of $107,250 plus our stockholders' equity of $682,500 to give us $789,750. Now, when we get this amount, we want to check and make sure that our assets are the same balance. If they're not, there's something wrong. Some of the things I've noticed that people can get wrong in this process is either they've misclassified one of the accounts and didn't get it on the right statement, and maybe even a more common thing is forgetting that the statements are prepared in a certain order, and each statement after the income statement has a number that's being followed down, that you have to follow all the way through the process. And I hope this really helps you to prepare your financial statements.